Recording in progress.
So just a quick summary of last week's market analysis we did. Let's start with Euro USD. Here we actually had two IDs. One of my ideas was for the market to trade into this order block and then give us a good trade. This actually happened, so it played out very nicely. But my other idea was for the market to take out this low, because I was looking at the Asian low as liquidity, as possible liquidity. So that's why I said we have two possibilities in the market to trade into this order block and react, or the market to take out this order block and react from somewhere here with confirmation entry pattern on the lower time frame. So this was two of my ideas. This one, the first one worked, it worked out perfectly. And it was also sort of like, this was accumulation phase. We had the manipulation and then the distribution in the market. So it was also accumulation, manipulation, and distribution setup. Now, I believe it was also daily cycle. So let's just look at that. So let's just look at the details here. So I believe it was also daily cycle setup. Here we had, obviously, London, and we had also New York. So it was also daily cycle setup. So once again, you guys can see how consistently this works in the market. Right. So it was also a setup of the continuation. Now it's a little bit different. So this is why I said it's possible for the market to trade down below this low, because now this is a little bit tricky, because the market did not take out the London liquidity, right? Excuse me, it did not take out the Asian low liquidity with the London open. So in this case, it was kind of tricky, but you see it still worked out and it offered quite nice trade. Obviously, it had to fill in this imbalance right there, which happened over here. So I believe it gave around 1 to 5 setup. So yeah, that was it. The next idea we had on Tuesday was a gold long. And here we had the idea of the market filling in this fair value gap, which you can see is exactly happens. So it's filled in the fair value gap, and that's when it reacted and started moving to the upside to take out these buy stops. Now, the reason why I had the idea of the market to take out these buy stops was actually it was Asian range. So I took a look at the market, and here, if you look at the Asian range, this is the Asian range high. That's the low right there. So obviously the high is not taken, and the high is at the old high, and that's what I've seen as buy stop liquidity in the market, and obviously it played out too. Now here, I tried to take a trade from here, which I actually did. I did take a trade from here and closed it somewhere around here. It was a small trade, just trying to get back my equity curve. So that's why I took a trade here. But the next day, we actually had a very nice setup, which was looking something like this. So we had, again, it was similar to a daily cycle actually, so kind of similar, but we see the same example here again. So in this case, again, the Asia low wasn't taken, but still this setup worked out quite well. So this was the range right there, and in this particular setup, this was actually the breaker in this case. So that's where the market came back. And if you look at the key zones in the market, we probably had something like this going on. This was London. This was New York. See, so once again, the market traded back into the New York, and that's where it gave the trade. But again, the same issue I had with Euro USD previously. So in this case, the market did not take the Asia range low. So it was kind of confusing for me to look at it this way, but obviously in hindsight, you could be pulling your fib level from this swing low to the swing high, and that would be a trade. So also this was the breaker. This candle was an order block. So it was, in hindsight, it was obviously a nice setup, but in buyers, we already had actually the bias of the market to trading up from this fair value gap, and we already had the bias for the market to take out these buy stops. And also, obviously, was this fair value gap. Now, if we have fair value gaps in the market, we can use that as also a tool to form our bias. So in this case, we had the fair value gap here. And if we have a setup down here, we can use the fair value gap as a tool, as a draw of liquidity in the market. So we expect the market to fill in the fair value gap in just a matter of time. So this was also part of a confluence, a part of the buyers for me to have these buy stops taken out in the market. So overall, I believe my ID worked out quite well. But something that was even better, so Euro USD, that was quite successful. Gold, we could say, all right, we called it the market to take out these buy stops. However, Australian dollar, US dollar, now this was something perfect. So if anybody remembers my market analysis from Tuesday, we had this setup. I actually haven't changed anything. I just left it like this, and look how perfectly everything played out. So here, this is what happened in the market. First, we had this low and this low. Obviously, was that equal lows in the market. So it's liquidity, and this low manipulated us. Obviously, we got the liquidity sweep right there. So once this happened, it was pretty clear to me that, all right, we have the liquidity swept. I cannot see any more interesting levels or liquidity below. So this was something that really caught my eyes, for these equal lows to be taken out in the market. Now that happened, and next thing was we had this sort of supply demand area in the market. Now here the market broke structure, obviously, so this was shifting market structure in the bullish direction, and then the market created a quite nice bullish pattern in the market. So this was liquidity. The market took that out and tapped into this supply demand area where it reacted. However, the next day we had a quite interesting setup we discussed on our previous community call. And this was also, just take a look at the times in the market, also the Asia range. Now this was a perfect daily cycle setup. So if you take a closer look, here we had the Asia range. So obviously we have midnight, which is 5 o'clock London, right there, 5 in the morning, which is midnight New York time. So here we had the Asia range low swept, which is obviously the pattern that I'm looking for mostly. which is the highest probability. So once this Asian low is swept, and then London rallies above the Asian range, that's when I expect this whole continuation daily cycle pattern to unfold. And it exactly happened like that. So that's why I marked up this candle. This is a bullish order book.
A régi, az a tiéd előtti kerül most 1.350.000. Ez.
Okay, sorry guys, just a moment.
És az a felszereltség, ami a tiéd, de ez is kézi váltós, az 1.439.000.
Okay, someone was speaking. Sorry about that, guys. So if you look at the pattern here, we had obviously London bullish, and then the market traded back into New York open kill zone. Now, which is 7 a.m. to 11 according to New York time. So according to New York time, it's 7 to 11. Someone actually pointed out on the previous call that these lows might be liquidity, because actually I believe on the 1 minute, someone was looking at this low as potential equal lows in the market. I actually wasn't really caring about that because it's just such a low time frame that it doesn't really matter. So even though anybody been looking at this as liquidity, we can still take the trade with a bigger stop loss, like 16 pips, just enough. Or if you're still worried about the market to making some manipulation, then just use a bigger stop loss. But overall, the setup was perfect. Also, something to notice is here we had actually triple bottom in the market. So that was something very clean. I seen that as liquidity in the market. See, so double lows, triple, almost four lows at the same level in the market. And that's where I measured actually a 10 pip sweep, which aligned. So if I change this like that, so you will see it's a 10 pip sweep, which aligned obviously with the optimal trade entry zone. So if we have something like this as a confluence, in this case, the 10 pip sweep, aligning with the optimal trade entry, that's a huge confirmation too. So this was the overall setup. I said these buy stops will be taken out. So this old high, it happened. And I also pointed out that this fair value gap is something we need to look at. So again, I've been using the fair value gap as a draw of liquidity in the market. So I've been looking at this fair value gap as something for the market to fill in. So I looked at this, it must be filled, and obviously it's filled there. Now the fair value gap actually can be used two types of ways. One of them would be you would take a trade here and you go ahead target these fair value gaps, or the other way of using it is you would be able to take a trade from the fair value gap itself and place a stop loss like that. But I wasn't even thinking about taking a trade from here because I was bending more towards the bullish direction and maybe, possibly reach this higher time frame point of interest like that. But overall, it was good setup. Now, few words regarding the Asian range, because once again, you guys can see that I'm using these standard deviations of the Asian range. Now, again, this is used as the target. So you see, obviously, two standard deviations right there. They reach very often. They reach in the market. Excuse me?
Enggak, aku butuh layar gede. Nih dia. Ininya cuma segini.
Okay, so probably you must be muted. Just a moment. Okay, sorry about that. So these standard deviations, just notice what I did here. So obviously we know that the market usually reaches 2 standard deviations at the high of the day, but you might notice that in this case, actually, the size of these boxes are different, right? So this one's much bigger. And the reason behind that usually when the market creates the low of the day, so let me just make a good illustration of this. Just add some color. So usually when the market is creating a low of the day below the Asia range, we wouldn't be using the standard deviations like that. So that's not the correct way to use it. We would be using the standard deviation. So let's just move this to the side so you can see the difference. So what we would do is first measure the market in the size of the manipulation, right? So we would measure this. And once you measure that, this would be the standard deviations you want to use, like that. So this would be the correct way of using it. If the market is trading below first the Asia range to create the low of the day. So that's the correct way. And this is what I did here, because if you notice, so this would be 1, and that's 2. So you obviously see the difference there. Right there, instead of being this accurate. So obviously there's quite some difference. So when the market is trading below, you would like to measure this distance, and it would work kind of like this. So you drag another box on it, you measure this right there, and that's it, you got your standard deviation. And this is the measurement you want to be using. So it's a very small detail. It's a small detail, but you will see how accurate this can get. Right there. So this would be the correct way of using the standard deviations when the market is trading below the Asia range. And then obviously, we just need to wait for the daily cycle to unfold. And yeah, this was the trade. Okay, if anybody has any questions, just please let me know. If you haven't got any questions, I might be showing a few more examples of this type of use of the standard deviations, because I believe this is something that's quite interesting. All right, so no questions. Okay, then we just move forward. Okay, I will show you a couple more examples. So let's just look at maybe gold. Another example, and in this example, I can also show you why we would use the standard deviation in that case slightly differently. So this is obviously another daily cycle setup. You will see a lot of these because it happens so many times. Now, this is the Asia range. And if I just use the standard deviations, you know what, let me just pull on a fib here right there, so you can see obviously it's daily cycle. So let's just use the standard deviations. So that's 1. So that's 2. So obviously 2 wasn't the high of the day in this case. This is the incorrect way of using it. 3 and 4. See, so it obviously went way above it. And if we compare it to the other one, where first you would go ahead and measure the distance of the market creating the low right there, then you would be able to measure a much accurate take profit level. Okay, and now I'm just looking at this horizontal line. I'm not sure what's this, but I'm pretty sure it's the fair value gap. And I believe in this case, the confluence would be for the market to match with this fair value gap. And let's look at this horizontal line. What's this? Okay, I'm not sure what's this. So sorry about that. I'm not sure why I placed this here. A little bit confused. I'm not sure why I placed this here. But yeah, in this case, you can see again, you know, it's a more accurate way of measuring the standard deviations in the market. So, you know, it's a small detail, but if you use your take profit, you know, it will be different, of course, right there. So maybe I can find a couple more examples of this. Just let me think where I've seen that. Okay, if anybody remembers this example, I've been showing this one a lot of times, so I will show it once again. So it's quite a nice example. Let's just find this one. Okay, well, this would be obviously another daily cycle, and regarding standard deviations, we would have 7 to midnight. Let's just see the difference. Okay. So actually, I'm doing this on a 30-minute, which I'm not supposed to, but let's take a look at also the 50-minute later on, so we can see the difference there. Not much difference in this case. See, so it was barely something. Let's see. 2, 4 is a little bit above, but obviously we would like to select the one that will be aligning the closest to an old high or old low. So this would be 1. let's see this old high. See, it's aligning with 3 standard deviations, so that's what you want to choose, this old high. So that's also another way how to select your standard deviations. Like that. So, you know, free was also close in this case because we need not have too much difference in the low of the day. So it wasn't a big sweep, but in some cases when it's quite a big sweep, you will see how significant this is. And maybe I can show you a more understandable example on Euro USD. Just let me find this setup. Okay, I believe this would be it. So what happened? Let me just go back to this one. So this is when it's quite different. See, let's see if you would be using 2 as your target. It's quite different in this case. This would be obviously the more accurate way of using it if the market is creating first high of the day above the Asian range. And then obviously the daily cycle follows. You just have to execute and use targets with the standard deviations, or you can also use Fib extension as your targets, standard deviations on the Fib 2. It works perfectly as well. And this would be 1. That's 2. You can also use a couple other targets, but I believe Asian standard deviations would be one of the most accurate way of using it. All right. So let me just read the chat. Just a moment. Paolo, All right, so Paul was asking if it's so hard to find examples, doesn't it? So if it's hard to find examples, you believe it doesn't play out often. Well, it took me a few minutes to find the examples. I want to show you the good ones. But other than that, if you take a look at the Discord, if you take a tiny bit of time to look at the Discord, you will see I posted actually an entire week of using this. And in an entire week, we had actually 4 times it played out. So I believe if something plays out 4 times in a week, I believe that's more than enough. Even if it plays out once a week, it's also just fine, because if you get one good trade a week, which is 1 to 4, 1 to 5, or 1 to 3, and you do that every week, I believe you will be funded and you will be trading full time, no time. But other than that, I actually posted a screenshot in my Discord, and you can see 4 examples in a single week. So I believe if something happens 4 times in a single week, it's pretty nice. Last example, did you consider the week? I didn't consider the week. Which one on the gold? I probably did. Let's look at that. It's on the gold. See? So you cannot consider the weeks. You have to use the body. So this one's not correct. You have to use the body. Should be used. Yes. All right. Now I pretty much understand your question. So yes, you should be using the standard deviation from the weeks, not the Asia range. So the Asia range shouldn't be from the weeks, but when you use the standard deviation, that should be from the weeks. So it's a small detail, very small detail. But when you would be pulling it from the high, see, that's when you use the body. But when you see what I mean, so in this case, I'm pulling it from the body to this week, and I'm not pulling it from this week to the body. See that? So it's a small detail, obviously. Also, you know, if anybody missed the last community call, I can show you a pretty nice example why actually I'm teaching to use standard deviations from from the bodies. Just maybe we can see it. It's somewhere here. Okay, it's quite far back in history. Now, all right, this would be one of the examples why actually you have to use the standard deviation. Excuse me, not the standard deviation. You have to use the Asia range from the bodies. Let me just show you an example in case anybody missed the last community call. If anybody wants to take a screenshot of this, then feel free to, you know, just the rules. And here I can show you why we actually want to use the bodies of the Asia range instead of the wicks. So this would be obviously, it's an order block. And let's say you want to take the trade from this order block, but you also want to use the standard deviations as additional confluence. So that's when you would go ahead and mark up the Asia range and use the standard deviations. And actually, I do know that I already been illustrating this example. Just the reason why I will show it once again, because I believe a few members miss this. So let's see the difference if I'm using the VIX. So that's the VIX. And now let's take a look at it with the bodies. Okay. This is why we are not using the VIX. Right. Anybody has any questions, just feel free to let me know. If not, I might end this call here and I will upload the recording.
Hello, I have a question.
Okay, go ahead, please.
You mark this Asia range, and in this case, we don't take also the sweeping because it's too small, or
It's actually a different setup, but you know, if you take a look at the sweep, let's see what we got there. Huh? Which one is it?